So today I'm going to discuss the true cost of making a pension choice. And the key thing here is the true cost of making a pension choice. Most people think, here are my two options, here's the cost. The discussion never goes much beyond that to uncover really what a pension choice is and how much it really costs the pensioner. So that's what we're going to look at today. Let's start by going over here to a CalPERS pension benefit statement. If those of you who are lucky enough to still have a pension, which is very few of us compared to what it used to be in the past, will, I'm sure, I hope, be very grateful for the fact that that you have a pension option. So this is actually what the CalPERS, you see up here in the corner, this is what the CalPERS benefit statements look like. Each municipality may have a little different format, but in general, this is what you'd be looking at. There are two primary choices when looking at your pension options. Now, there's many different choices here on this CalPERS. It's actually, if you'll notice, I mean, it's 6 different pages. I'm going to focus on the two primary benefit options that most people will compare. Number one is up here. It's called the unmodified allowance. This is also called the single life option. This generally pays out a maximum payout to the pensioner with much less, and in some cases even zero, left behind for the survivor. Okay, in this case there is a survivor benefit, but it's a significant cut, a halfway down the ladder there. Now the second option, the one that most people who are married with family will choose, is option 2. Option 2 down here is also called the survivor option. The survivor option says that you take a reduction in the payout in exchange for a guaranteed benefit to your survivors. So you can actually have a portion of this go to a beneficiary, a portion go to someone else, a spouse, or you could have that $12,505 go to one person as your survivor and beneficiary. So what we need to look at here is a comparison between these two benefits and find out what the actual cost is of that benefit choice. So let's go over here to my other page, grab where my notes are, and let's take a look at the true cost of a pension choice. So number one, we know that if we take our single life option, this is where we get $13,291, and that's a monthly benefit. And we get that monthly, but we generally get that as long as we live. If I'm the pensioner and I die before my spouse, then this benefit stops or is cut dramatically, and my spouse is left with substantially less or zero. So usually that is not the option that a spouse or the beneficiaries would like you to take, so we generally will take the survivor option. So the survivor option is $12,505 per month. Now, when we look at that, that is actually a reduction in pay of $786 or $9,432 per year. Okay? So now, the real question is what does that represent? What is the true cost? Now, in many discussions where we're sitting in our CalPERS meeting or our CalSTRS or our pension benefit discussions, this is where the discussion stops. I would submit to you here in this class, we should ask, what is it really going to cost to take that benefit, and what are we really paying for? So here's the question. What financial product Okay, what financial product leaves money behind to a survivor when someone dies? What financial product leaves money behind to a survivor when someone dies? The answer is life insurance. Life insurance leaves money behind to your survivors. So, the reality of this pension choice is that you're actually purchasing life insurance from the pension company. You're actually buying life insurance from, in this case, CalPERS. So $786 per month for the duration of retirement to make sure that we leave money behind to our survivors in the event that we died suddenly. Okay? So now, the question then becomes, what does that life insurance really cost us? So let's analyze this. Let's go to this next page here where we're going to do a bit of an assessment. Now, if you notice, the retirement age here was 53, 54. At 54 years old, if you're healthy, is it possible that a husband or wife could live to be 90 years old nowadays? Absolutely. So we have to figure out, how much does this really cost over the course of a lifetime? We could actually have, in this situation, we could actually have 36 years in retirement. 36 years is entirely possible. So what was the cost of that joint survivor pension? That joint survivor pension was $9,432 per year. Okay, now here's the big piece. This is an important discussion point that is often missed. Lost opportunity cost. LOC. If you've never heard that in your pension discussions, it's critical to notice this piece. So here's my question. If you were able to choose the single life option and take that maximum payout, and if you were able to keep that $9,432 in your pocket, and assuming that you were responsible with it, couldn't you save that money? Couldn't you keep that money in your own pocket if you knew that you were going to live a long and healthy life? If you had a crystal ball that says when you're 90 you're still here, couldn't you have kept that $9,432 and perhaps invested it and earned a rate of return? So let's take a look at that. What if you could actually earn, let's just say, 4.5%? Not 12% like some financial entertainers talk about, but just 4.5%. So let's take a look. What would happen if you could actually earn a rate of return on that money? Let's take a look at a future value. Here we go. Let me make this a little bigger. So here, if we have $9,432 per year, and you saved it, and you were able to earn 4.5% for 36 years, lo and behold, that $9,400 a year turns into $849,000. $849,000. So let's write that down in here. That's $849,270. So who does that money go to? Who gets to keep that money? Well, of course, CalPERS or the pension company keeps this money, because this is life insurance. So this is the true cost of the life insurance to you, is the money that you never get to earn on it. The pension company gets to earn it. So that's $849,000. So next question. What kind of life insurance are you actually paying for when you get the life insurance coverage from the pension company? So we're getting this benefit. Of course, the guaranteed income to our survivor is a huge benefit, but what kind of life insurance are we paying for? So here's the question. Do we get to keep any of this $849,000? If you're the pensioner, do you, your wife, your husband, your children, your grandchildren, do any of them get to ever have that $849,000 in potential money? Of course not. So let's look at what kind of life insurance are you really buying when you're choosing the joint pension option from CalPERS in this example. So here's our two primary types of life insurance. The first, up here at the top, is term life insurance. Term life insurance is a death benefit only. It builds no equity value, no cash. It only pays if you die. And the way to think about this kind of coverage is you think about renting your coverage or renting an apartment. You don't have any value from that asset. Okay? So next, the other type of insurance that's out there is whole life insurance. It's referred to as many things, but it's whole life insurance. Whole life insurance has an equity component, a liquidity component, passes on a legacy. It is completely guaranteed, and the owner of the whole life contract maintains control of the asset. Think banks and billionaires. Banks and billionaires own whole life. They own that type of life insurance. So let's go back. $849,000 is the actual lost opportunity cost in this example of taking that reduction for the life insurance coverage for the survivor. Who gets to keep the $849,000? The pension company. So in this case, if you have no equity, no value, the only way to get the benefit, this benefit here of $12,505 to a survivor, is to die. So the type of life insurance that you're getting from a survivor benefit option on a pension is term life insurance. At its very basic definition, you have no value, no equity, no liquidity, no legacy, and the only way you get money out of it is to die. So the question to ask yourself, if you are a pensioner or you know somebody who's coming up on a pension choice, which would you rather have? Would you rather have an opportunity to actually hold the equity, maintain the liquidity, the legacy, the control, or do you like the idea of renting the benefit and leaving what could be a gigantic amount of money on the table that never goes to your family? There are options, there are ways to actually plan for this. You can head on over to personalpensionformulation.com for some more information. You can also get in touch with me. My email address is Kraig with a K, K-R-A-I-G, at tfpartners.net. Thanks for listening.